Hello, Darwiners! Welcome back to another episode of Darwin Investors. A little bit of a rougher week on the market last week. The S&P 500 had its first down week in a little bit of time. I still managed to make some money. I'll show you how much I made and how I did it. I'm also going to show you, give a little preview to the earnings that are coming up this week and some plays that I plan on making in the market this week to try and help me make some money regardless of which direction the market actually goes in this week. And then lastly, I'm going to show you what direction that I believe the market is actually headed in. I don't think there's much going on here. So, because we have oil prices that are range bound, we have interest rates that are range bound, we have low unemployment. I think that that's a good thing. You know, how many times you like turn on the TV and or read articles where they say low unemployment is bad? I mean, what kind of sadists are these people? No, low unemployment is good. It keeps people buying things. It's the reason why earnings have been coming in good, why companies are remaining profitable. Those that were profitable in the first place. Yeah, we've had an asset crash, but it's been in unprofitable companies. Those that have been making money have remained fairly strong. We have a 50 basis point hike that's already baked into the S&P 500. So unless they come in a lot more hawkish, that's not going to change. And that's not going to change because when that CPI print comes out on September 13th, we're going to find that inflation is coming down even more than they think it's coming down. And I'll get into those figures later on in this episode. And last but not least, inflation on that topic is coming down. It's high, but it's coming down. Housing prices are high, but they're also coming down. And housing prices cooling off is a good thing. It's good if we can afford homes. That's not a bad thing. And they're coming down in such a way that the home builders aren't even really losing any money because they haven't made so much supply that they can't sell what they have, which is what's keeping housing prices high. We have kind of like a very stable slowing economy, if you will. The soft landing that Jerome Powell has said he's going to do, it's looking like it's happening. The guy might end up being, St. Jerome, he might end up being the greatest Fed chair in the history of the US Treasury. If he can get us through COVID and just shutting down the entire economy and do it in such a way that doesn't crash employment and it doesn't make all the businesses lose a whole lot of money, and he does it in such a way that the stock market comes down at a level much higher now than it was back before the pandemic in 2019. If he does all of that, which it looks like that is exactly what's happening, he is going to go down as the greatest Fed chair in the history of the United States Treasury. So let's go ahead and get into everything I got here. So what do I think is really going on in this market right now? You know, what do I think is actually beneath the hood of a lot of this pessimism that we're seeing out in print? Well, a lot of it, I believe, has to be with the fact that these hedge funds are overweight cash, they're underweight equities. They basically missed like this 20% bull run. They need it to come back down so they can put their cash to work, but they're kind of mad at themselves for missing this in the first place. And this came out on the 17th of May that hedge fund managers were extremely bearish, taking their cash levels to the highest level since the 9/11 attacks. And that came out on the 17th of May. And then on the 3rd of June, this Savita Subramanian, she's Bank of America's US stock chief, she sees a floor of 3,200 for the S&P 500, but she did happen to like 4 sectors, and you can take a guess of what sectors that she happened to like. She liked energy, which was trading at an all-time high. She likes financials because she works for a bank. She likes healthcare, Eli Lilly and Merck trading at all-time highs. And she also liked consumer staples. We're not only trading at all-time highs, but all-time rich valuations. You had companies like Costco and Kraft Heinz trading at like 50 times earnings. And so she likes all these companies trading at all-time highs, but was steering away from all the companies that were actually a deep value here on the 3rd of June. And if I look at the 3rd of June, let's see if that was actually a Friday. The 3rd of June was a Friday. Folks, this right here, this is why we have to return to the office. She was probably at home. She had a few beers, and then they called her up and said, Savita, what do you got for us today? She says, well, I don't know. I think the S&P 500 is going to go to 3,200, and we should buy some stocks at an all-time high. These are things that you should not do. You should not drink beer at home on a Friday and make stock predictions. Leave that to the professionals. And speaking of, here's a word from my sponsor. Guys, are you having a hard time getting rid of that stubborn, flat stomach? Do you sometimes think that when you're in a crowd, you're not talking loud enough? Well, do I ever have the cure for you? That's right, it's from my sponsor this week, which is beer. I gotta admit, I'm feeling smarter already. All right. Best of luck to her, rookie. Well, because of her, the fund manager sentiment drops to dire levels, according to Bank of America. And that came out on the 19th of July. And what we're finding here is just it's the height of ridiculousness, if that's a word. We have the net percent of fund managers expecting a stronger economy. So here's the dark blue line is those funds that are overweight equities, and then the light blue line is the net percent expecting a stronger economy. So you can see that they're very underweight equities and they're overweight cash. And not because, and they're thinking, oh, well, because the economy is going to be really weak. And it's actually a lower level now than it was back in 2008 when Lehman Brothers and Bear Stearns crashed during the financial crisis. You know, this is like the same thing as having Goldman Sachs and Morgan Stanley crashing today. That's what we're comparing this to. We're comparing today with like 3% unemployment to banks crashing. It's just nonsense. And then here we go. The net percent of fund managers taking higher than normal risk levels. Again, lower than today than way back in the great financial crisis. I just can't believe how offsides these companies are. Like they're too smart for their own goods or something here. It's almost like if you have like a dog, and I used to have a cat that would fetch. And if I would fake throw like a ball or something like that, the cat wouldn't budge. And they'd say that that cat is dumb because it doesn't have what's called object permanence. It wouldn't actually move until I threw the ball. Versus a dog, you can throw that ball and that dog will take off running and you can have the ball in your hand. It's like running all over the field. Go, where is it? Where is it? Where is it? And that's kind of what these guys are. They're like the dog that's too smart for its own good. And I'm just like the cat that's like, well, show me the data and I'll make a move from there. Anyway, I digress. So hedge funds are sitting on a record level of bearish bets on the stock market. And this come out on August 18th of 2022, which was just a couple days ago. And what we're finding out is that net short positions against the S&P futures by hedge funds have reached a record $107 billion this week. Now, a lot of these could be protective puts against their long positions, and probably are. But nevertheless, this is the largest amount of money that's ever been put in a bearish position by hedge funds in the stock market. And that just happened this past week. So we're sitting on a whole lot of bearish sentiment. And why is that? Well, because they're mad because they missed out on a 15% rise and they want to get back in. That's my thesis. And then to like muddy it up even further, we've got an election that's coming up, and so everybody's trying to spin these things in their own little way. And when I saw this data come out, I thought it was very interesting. It's where voters see a bad economy even if they're doing okay. So if we scroll down here, we're going to find that thinking about the nation's economy, how would you rate economic conditions today? And Democrats think that 19% say it's good, and then 43% say it's fair. So the total of 62% think it's either good or fair, versus Republicans, only about 20% think it's good or fair. Now, we're living in the same country, but we've got a wildly different view on what the economy looks like today. And I think a lot of that is based on the news outlets that people choose to engage in. If you scroll down here, I think it's interesting. It says, thinking about your own personal finances, would you say that your personal financial situation is in excellent shape, good shape, only fair shape, or poor shape? And again, this is divided pretty strangely down party lines. Democrats would say that 55% of them might say that they're in good or excellent shape, whereas only 41% of Republicans would define themselves in good or excellent shape. On a personal level, I have way more money today than I did a few years ago. So I would have to put myself here in the 10% class. I'd be one of these, I guess I'd add to this little pocket here, this other 6%. And I think if most of us are honest and we've been engaging in investing, probably a lot of us would find that we're in better shape today than before. But you can't blame anybody for thinking that they're in worse shape, given the way that inflation is eating away at the amount of stuff that they're able to purchase now, relative to what they were able to purchase a few years ago. So, what do I believe the truth is, and where do I believe we're headed from here? Well, I believe we're just going to trade basically sideways. And we're going to trade sideways, and I'm going to sell covered calls. I haven't been selling them lately, but I'm about to start selling them again because I don't think there's this catalyst to drive this market straight up, nor do I think that there's this catalyst that's going to drive the market straight down. And for that, I'm going to be selling a lot more covered calls. I'm going to be selling puts. It might be on the same equity. Now, if you sell a covered call on the same equity that you sell a put, that's called a strangle. So I might be creating strangles on my own underlying, or I might just be selling covered calls and looking for opportunities to sell puts in other equities. And this is going to be the direction I'm going to be headed in the short term because I don't see another market catalyst coming out until the 13th of September. The 13th of September is when the next inflation read comes out. And as we know, this entire market's being driven by the rate of inflation. And so where are we expected for the inflation to come out at? Well, here on Trading Economics, we're looking at the forecast for inflation. We're seeing it's not out yet. However, Bloomberg has kind of forecast out a little bit, saying that they expect that core CPI could approach 7% in the coming months. We don't know what that means exactly. It just means it'd be September, October, November. But they do believe that U.S. inflation runs cooler than forecast, which will ease pressure on the Fed. And so this is where we kind of see this going. If the inflationary pressures do come down, I do see this market shooting straight up. So I'm be very careful selling covered calls going into that inflation read because I do expect the market to get a bit of a tailwind after that information comes out. And the reason why I feel like that information is going to be good, and the reason why probably Bloomberg, and I hate to put words in their mouth, but the reason why they might think it's going to be good is because a lot of the inflationary problems came here from food at home and food away from home. And we can see that month over month, these appreciated 1.1% and 1.3%. And if we look at these numbers, it's much larger than many of the numbers that are down here other than electricity, and even higher than shelter, which came in at 0.5%, which was actually down from the month before of 0.6%. Now, why would we think that food at home and food away from home would be coming down? Well, one is commodity prices are coming down, so we could kind of see that coming. However, there has also been some other more practical data that's been coming out to showing that inflation is peaking, that 10 common consumer items where prices are falling. So we're able to empirically see that prices are falling in certain items. And of these items are chicken, butter, eggs, milk, hot dogs, tomatoes. You get the point. Food is coming down in price. And if food is coming down in price, that's going to lower this number month on month. And if this number comes down, and it seems to be about the biggest numbers that we see in this here screen, we're going to expect that inflationary pressures are going to come down, and that's going to send the market higher. Another reason why I think the market could go higher is because we have jobs and we're still spending money, but we're spending money smarter according to this. They're saying that July's retail sales data from the Census Bureau added to a picture emerging of an American consumer still spending even amid biting inflation and lousy sentiment. July retail sales were unchanged from June, but retail sales excluding autos and gasoline rose a healthy 0.7%. We're still spending money. And that's what the earnings are showing too. These companies are remaining profitable. And one of the reasons they're remaining profitable is the jobless claims edged lower. And this came out on Thursday. Jobless claims totaled 250,000 for the week ended August 13th, down 2,000 from the previous week and below the 260,000 Dow Jones estimate. For whatever reason, the market sees this as bad. I understand this says, oh, that means Powell's going to have to raise rates. We've only baked in a 50 basis point hike. Now we maybe have to start thinking about a 75 or 100 because of this. But I'm not in that camp. I think that people with jobs is a good thing, and I'll always be in that camp. I'm on the side of employment. And if we look over to housing, the housing market predictions of 2022, when will the prices drop? Well, we're showing that that existing home sales dropped 5.4% from May to June, marking the fifth consecutive month of declining sales. That's not a terrible thing. And declining prices is not a terrible thing. The median sale price of these homes reached a record high of $416,000 in June, up 13.4% from a year ago. All of this indicates home prices are not dropping anytime soon. However, MBA economists also don't see home prices falling in the near future. They reported a median sales price of an existing home at 361 in the first quarter, 402 in the second quarter, and then slightly coming down to 379 in the third quarter. So this is not a crash. And the reason why it's not a crash is because home builders are very careful about how many homes that they're leaving out on the market. Here's the active listing count in the United States. We're currently sitting at 747,000, which is a lot lower than here in July of 2016 when we had 1.5 million, and much lower than we had here in July of 2019 when we had 1.3 million. So they've adjusted their inventory to reflect the economic conditions that we're having today, meaning that a lot of home builders are not going to go under, but they still have to sell those houses, and they're going to have to cut their prices to do so. And what about company earnings? Well, here it is from August 17th, corporate finance briefing from Yardini, S&P 500 revenue and earnings growth rate. We can see that companies in Q1 were growing their revenues and earnings at about 14-15%, which is historically very, very good. Actually, latest is 13.6%. We can see that their operating earnings per share on a yearly percent change was 11.8, which again is historically pretty good. And we can see that in the future, we're looking at revenues annual growth forecast. And we can see that right here in 2023, it's not extremely high compared to 2022 or 21. It's much higher than 2020, but it's about the same as 19. Well, actually, here is the chart right here. We're coming in at 3.9%. Which is much lower than the past couple of years, higher than 2020, and about on par with 2019. So this is not awful. In operating earnings annual growth forecast, again at 7.3% is better than 2019, not as good as 2018 or 2017, but in any case, it looks like it's pretty normal for growth forecast for operating earnings. So what I'm saying is that the market and the economy seems to be in okay shape. Nothing that's going to like send us to the moon, but again, nothing that's going to send us through the floor.